Good morning, and welcome to another edition of the Weekly Market Note with Main Management. As usual, I'm Alex Varner, our head of research, alongside
James Maxwell, VP of Research.
Let's get into it. This week was pretty heavy on inflation data. The week prior was employment, so we got kind of both sides of the Fed's dual mandate, and that's squarely in focus this week with the rate decision coming out on Wednesday at the FOMC meeting. Performance last week, just to touch on this briefly, but far more positive than negative. One of the big notes was Oracle jumping 40+%. I think that gave Larry Ellison a nice $100 billion net worth boost, which is the biggest single day of wealth creation that we've seen in ever, I think. On the recession dashboard, not a ton has changed here through September as we're kind of moving in. We're now halfway through. Hard to believe already, but here we go. Mostly blues across the bottom. As we mentioned, the big data this week was CPI. It posted a plus 0.38% month-over-month reading, so slightly above forecast for a 0.3% gain. Year-over-year is up 2.94. Both of those were the fastest since January. Core CPI was also a bit above expectations at 0.35. Again, the highest since January as well, and it's now up 3.11 from a year ago. I think the Fed is kind of fairly favoring the labor market here with the kind of the way the markets are interpreting it, with the markets are, I think, 95% chance of one cut, you said?
Yep.
And maybe 5% chance of two. So definitely favoring a cut come Wednesday to 4 to 4.25.
We were talking a bit about this last week, but it seems like, at least to us, that the market and the Fed kind of see this inflation is peaking its head up a little bit because of things like tariffs or these one-off effects, and are probably kind of silently fine with it.
Yeah.
Because of the labor market, because of the weakening, or you can call it stabilization, you can call it normalization, but it is broadly worse off than it was maybe a year ago. They're willing to kind of look through the inflation side of things and say, let's focus on the more kind of important or prudent thing of our dual mandate.
Yeah. Which right now is the labor market.
Yeah.
I think you've seen that. You've heard a lot of talk about that with the downward revisions that we saw to June and July, and then that kind of benchmark 1 year through March with a negative 900,000 revision. Last year was like 500,000 or 600,000 as well, maybe more.
I think
than
it was
that.
800.
It was 800.
Yeah.
So you've had a combined 1.7 million kind of jobs that weren't created that they kind of initially thought were. And again, I don't envy these guys trying to figure out the birth death rate, replacement rate, the immigration issues, as far as the numbers. Those are really kind of complicating matters, but it seems pretty clear that markets have kind of decided, and the Fed has also leaned into being more willing to support the labor market through cuts than to try to combat inflation. Again, it's also important. The long-term target is 2%. We lived at 1 to 1.5% for several years between the GFC and COVID. And so if you take a long-term range, over 10 years, and you lived at 1.5 to 1, you can live at 2.5 to 3. And so I think, as James mentioned, the Fed is kind of implicitly okay with inflation as it is here. If it were to jump to 4, 5, 6, maybe you might see something kind of change a little bit. But for the time being, if it remains around this level, I think they're going to continue to favor the labor market with kind of more cuts. And markets are now looking at 3 cuts through the end of the year, and then 1 in 25 and 1 in 26 and 1 in 27. I think that's kind of the path that they're. But we will get the summary of economic projections, so we will see kind of the intended longer term path that the Fed views. So again, that's Wednesday. Kind of a little bit more on the CPI under the covers. Both shelter and food posted multi-month highs on a month-over-month basis. Food jumped 44 bips, and services were up, shelter was up 44 bips, and food was up 0.46%. Shelter had an easy comp, and that year-over-year figure has continued to slide to 3.64. That's the lowest since October of 2021. Food, on the other hand, is going the other way. It's up 3.2% year over year. That's the fastest increase since October of 23. So not ideal there for kind of people in the grocery stores on a weekly basis, seeing their prices go up. Again, goods and services as well. Tariffs were still are a big kind of point of conversation around this and where they're going to start showing up. And you're kind of seeing this in goods potentially accelerating here. They were up 0.46% month over month. It's one of the bigger monthly gains in the last couple of years. The year-over-year figure is up to 1.37, which is the highest since September of 2023. And services decelerated a bit, basically unchanged at 3.8, but just kind of showing here that, services are kind of moderating, and the tariffs are really on goods.
Yep.
And that's where you're seeing kind of these pickups potentially. And then within goods, you can further break it down. We look at durables and non-durables, and both of those posted solid, large monthly increases in August. Durable goods were up 0.42%, the biggest since September of 24. They're now up 1.9 or over 1.9, which is the fastest since November of 22. That's kind of on the left there. You can see that blue line just straight up and to the right, and those are the durable goods just accelerating on a price basis, which is not great. And then non-durable goods, again, starting to trend higher. And so I think you're seeing the tariffs kind of start to bite here. The good news is, well, you're supposed to only be able to put tariffs on once. And so once they go on once, they don't get reapplied again after that. So the year-over-year figures, again, as they say, this is a one-time bump. It still doesn't feel good, even if it is just a one-time bump. So we'll see if those kind of continue.
It's funny to me, kind of thinking back over the tariff narrative, I guess since even April or prior to that, since the market bottomed around April 7th, April 8th, you then had this kind of massive rebound over the past, call it 4 or 5 months. One of the things that was brought up by a lot of market commentators was, there is this inflation that's going to come from tariffs. Like, it's only a matter of time. These companies will apply it, and you'll see it flow through to the inflation numbers, like as this red flag that was coming and coming and coming. And you're kind of seeing it here for one of the first times, or very clearly, I think, here for one of the first times. But you see the market really doesn't care.
Yeah.
Any of that fear or concern about inflation coming from the tariffs, I think, was probably front run, or at least responded to kind of immediately
in immediate aftermath, March, April,
the immediate aftermath, and then the actual economic data comes out, months later down the line, and it's kind of a shrug your shoulders. Okay, we're on to the next story.
And I think it's been driven by, you've seen consistently strong earnings. And margins have remained solid in the face of these tariffs. So I think we touch on, well, actually, since let's go to the PPI. So the PPI came in well below forecast. It was outright deflationary on a month-over-month basis in August. Both headline and core were down 0.12% month over month, well below expectations, which were plus 0.3. The hot July readings were revised lower as well, so that's a good thing. But I think the big thing here is the takeaway that these were the culprits for these were wholesale and retail margin compression. So that's not great for businesses. Is you don't like to see them essentially eating the costs of those tariffs, of those increase, and whether or not they're passing them on to consumers is TBD. But if they see their margins start to erode, far more likely that they'll look at passing those price increases through to customers. But with the headline, the PPI and the CPI, we now kind of have the core PCE components. The weightings are a little bit different, but I think from what I've seen is it seems like this time around, the weightings and the composition of core PCE is a little more favorable to a potentially lower than expected number. Or a less inflationary number.
The expectations I've seen is a 0.2 month over month reading, which would be a 2.9% year over year for that core PCE, which again is the Fed's preferred inflation measure. That is lighter than you saw in the CPI or the core CPI because of, as Alex mentioned, the specific weightings of the underlying components are slightly different and the calculations are slightly different. But that's the expectation right now, which we'll be getting at the end of the month.
Yeah, and here within the PPI, we can also, they break it down 100 different ways as well. But on the goods and services, services fell 0.24% month over month. That's the second biggest monthly decline since April of 2020. They slowed to 2.9 year over year. Goods have been more inflationary. They decelerated a little bit month over month, but you can kind of see, I tried to draw a channel there, but you can see that kind of upward trending line on the goods PPI number for a year over year basis. They were down 4%. Minus 4% year over year, a little over 2 years ago, and are now up to basically 2.2. So that's kind of another sign of the inflationary piece there on the tariffs, especially. Shifting gears a little bit, we got the NFIB Small Business Optimism Index that missed forecast slightly for 101, but came in at 100.8. It's the highest since January. So it's good to see it kind of, trending higher. As you can see there, it was mired at recessionary levels basically until the election. And then it shot higher and then retreated. Kind of classic market overreaction, overreact the other way, overcorrect the other way, and then kind of as things settle out, figure out what's actually happening. But despite the headline index improving, the percent of firms viewing the next 3 months as a good time to expand ticked down to 14%, and the outlook for general business conditions over the next 6 months ticked down to 34. But again, those are both above their long-term median, so that's more positive than negative there. I think on the sales was a little mixed. You saw kind of expectations improved to plus 12%, so that's net firms expecting higher versus lower sales. So 12% more firms are expecting higher sales than lower. And then the prior 3 months were a little bit weaker. And then on the pricing side, it is good to see both the kind of actual price changes, so firms that have implemented price hikes, and then price change plans or pricing plans where firms are going to implement, both slowed a little bit. And that's kind of good for the inflation moderation. But again, if you kind of tie that back to the PPI, where they might be planning to not raise prices. But again, this is important that it's net more are planning to. It's just kind of moderating a bit. So we'll see if they see their margins. Maybe more firms go, oh shoot, we should be raising prices here. So maybe that shifts a little bit.
Yeah, it seems like we were talking about the margin picture earlier, where naturally they see margin shrinking or they see it hitting their input costs, that they would start to think about planning to raise prices. So I'm surprised it's not been stronger of a reading. I mean, it's still positive, but it's not stronger than it was, say, 6 months ago.
Yeah. So we'll see where that's kind of where that's headed if that starts to eat into them. And then finally, the last piece here, we got the preliminary Michigan Consumer Sentiment Index for September. It fell to 55.4 from 58.2, well below forecast for a 58 reading. Expectations declined, current economic conditions declined. Inflation expectations went up. So these are pretty highly correlated, I guess, or oppositely negatively correlated, in that when inflation expectations go up, consumer sentiment goes down. The 1 year was unchanged, but the 5 year rose to 3.9 from 3.5. And again, this thing on the left there, you can see it's just structurally lower than it's been. So I think we kind of, view this as it's not the best indicator of maybe how people are feeling, but it's still something that a lot of folks look at and give some credence to. And I think you are, it is maybe directionally representative of kind of the way people are going, where you're seeing the labor market worsening and the headlines are saying, hey, we lost 1 million jobs on the revision. Like, that doesn't feed great into people's psyches. And I think that's kind of reflected here.
I do know that this UMich survey is particularly sensitive to inflation and inflation expectations. Like, it's one of the big components of it versus some other consumer surveys, like the Consumer Confidence Board. Yeah, Consumer Confidence from the Conference Board is more sensitive generally to the labor market. So that could be one measure, is purely that inflation has not been below 2% since 2021,
and people are still kind of anchored there. They're used to 1.5%, 2%.
Exactly. Yeah. So it's just forever been broken by that spike in inflation, obviously, we had, and then kind of the residual stickiness over the past couple of years, and then also the rebound in inflation expectations because of tariffs. I could see why it looks structurally broken, just given kind of what's going on in the inflation expectation environment.
Yeah. So it's a tough spot to be for kind of conducting these surveys. And we also got some MBA mortgage data it's worth here. So ahead of the Fed meeting this week, kind of mortgage rates, bond yields are anticipating a cut, and what that means is they're moving lower. So the 30-year mortgage rates have followed suit. On the left there, you can see the effective rates at 6.66%. Hopefully not an ominous reading. Contract rate is down to 6.49. Those are both the lowest since early of October 2024. And on the right there, you can see the MBA, the mortgage application and refinance indices have moved higher. The applications index is all the way up to 298, its highest since mid-2022. And the refi index is up to over 1,000, its highest since the end of September 2024. So maybe you're starting to see a little bit of kind of unlocking of this frozen housing market. We get building starts and housing permits this week as one of the data points. So not quite the new home sales and stuff, but again, maybe these lowering of mortgage rates kind of starts to encourage buyers to get off the sidelines, especially as we mentioned, we'd seen some moderation in the housing prices on those indices, the NAHB and Case-Shiller housing price indices. have been negative month over month. So maybe you're starting to see some of the rates. And I think if you get, a 5 handle on these, and again, maybe that's a couple of cuts away, but nonetheless, if you get a 5 handle on this, I think that's a really big mental barrier for a lot of people. If they can get in at 5 when rates have been 6, 7, almost 8%, in the last couple of years here, if they get a 5, that's going to feel really good. And they'll kind of take that rather than being like, oh, well, it used to be 3.
Yeah.
Now it's used to be 8, and 5 is far better.
The kind of look back window is
shifting forward.
Yeah, exactly.
Yeah. The more, what have you done for me lately? And they can say, hey, we've gone from 8 to 5 or 8 to 6. That's a good thing.
What a deal.
Exactly.
Yeah.
What a deal, indeed.
One thing this does kind of remind me of is right around a year ago when you had the first Fed rate cut, you saw mortgage rates come down, or kind of the long end of the curve come down a bit into that. And then right when they cut, they rebounded pretty considerably. You can actually see it on the graph there, September of 2024.
Yep.
Who knows if this time will be,
I think the 10-year bump jumped 100 bips after in the wake of the cut.
Yeah.
Because it's like growth is good. Rates move higher in growth environments. Right. And growth is generally aided by cuts.
Rate cuts,
So it's kind of a funny
dynamic
dichotomy there.
When you have the long rates and you're cutting the overnight rate.
Very short end,
the relationship can be obviously complex.
Yeah, indeed. So that's kind of the big level for the high level data for the week. This coming week, again, as we mentioned, we get the FOMC. But to recap, CPI in a little bit harder than expected. Nothing huge, but you're seeing a more evident show up of the tariffs in goods pricing. PPI was well below forecasts. Margin compression was the main driver there. So that's, kind of not great for businesses. Despite that, the NFIB Small Business Optimism Index moved up to 100.8 as expectations kind of on the net improved and the price indices softened. Consumer sentiment continues to kind of be unable to get out of its own way. And as James mentioned, the inflation really plays heavily into the weighting and methodology of that Michigan survey. So that's kind of very closely linked. And we think it's a little bit maybe more pessimistic than it should be. MBA mortgage indices have been rising as rates have declined in anticipation of the Fed cut this week. And again, 95% chance of a cut. So we will see what they bring on Wednesday. I've seen some scenarios where they're even delineating market movement between a hawkish cut and a dovish cut. And that's all based on the language that
I do
accompanies
think
it.
The language and then also the summary of economic projections where they kind of give their forecasts for the next few years will be the most important things to watch. Like the cuts all but guaranteed at this point.
Yeah.
I don't think that
you're 2 days out with a 95% chance. I think it's if you're 70 or above, it basically happens.
I don't think that's even the thing to watch. That'll be the headline. But
but you
have to look at
the SEP also gives you get the longer term rate path, but also you get inflation and GDP forecasts. And so you want to see if those are revised meaningfully relative to June.
Yeah. We'll obviously talk about it next week when it happens.
Yeah, we'll see you then. Thanks again for joining us. Have a good week.
All right. Appreciate it.